Today is Wednesday, 22nd of September 2021. What is a special purpose acquisition company's equivalent? SPACs are special purpose acquisition companies are shell companies that have no business or assets but are designed to raise money through an initial public offering (IPO) and then later use that money to merge with or acquire a private company. A private company. Here's how it works. The management group called sponsors decides to form a SPAC. They raise money through an IPO by selling units. These are typically priced at $10 and are usually made up of one share and warrant or partial warrant. A warrant is a contract that allows investors to buy a certain number of additional shares of common stock at a certain price at some time in the future. Because SPAC units trade like stocks, investors can buy or sell shares for the current market value after the IPO. The money raised by the IPO goes into trust. The trust account typically invests in money market funds or certain U.S. government securities. The sponsor usually have 18 to 24 months to buy a company that they think shows tremendous promise. If an acquisition is made, the SPAC is dissolved, and in most cases, investors will be entitled to an amount of the total trust proportional to the number of shares they own. If a target is identified and approved, the SPAC and the target visit combined into a publicly traded company. This is known as the de-SPAC process. As part of the de-SPAC process, shareholders can decide whether to stay invested or pour their money out. If investors stay through the acquisition, then their investment will rise and fall with the share price of the company. Why would a private company want to go public through a SPAC? Many see it as a way to get the cash influx of public markets while bypassing some of the regulatory hopes and hazards of a traditional IPO. In addition, there is greater price certainty and control over the private company compared to a company taking the traditional IPO route, because there is less guesswork in determining at which price to offer the shares. Management expertise that may be part of the sponsor group can also be key in helping companies continue growth. Some investors like SPACs because they give them the ability to get in early on in IPO, which may have enormous potential. If the SPAC is successful, the price should appreciate. Investors will make money. In fact, investors may be able to exercise their warrants and buy more shares at a lower price. Of course, there is also a possibility the investment could last better. SPACs have been around for decades. In the past, they had a bad reputation for scamming investors. However, the SEC started regulating SPACs in an attempt to reduce fraud. The regulation granted investors the right to redeem units before an acquisition, while SPACs remained relatively unpopular for years. In the last decade, they experienced tremendous growth, with IPO counts moving from 1 in 2009 to 248 in 2020. Examples of high-profile SPAC companies include Rapid, Coca-Cola, Virgin Galactic. More than $83 billion were invested in SPACs in 2020, each fourth of the $13.6 billion in 2019. However, as with any early stage investment, there's risk. So, how does investors determine whether to invest in SPAC? Here are some things investors should consider. First is the management team or sponsor. Because there's no company to start with, no assets, no product, no track record. Investors are betting on management. In recent years, SPAC have used high-profile sponsors like James Palihapitiya, a former table executive, or Bill Ackman, a famous hedge fund management. Many investors look for these executives to strike traders once again and take the investors with them. SPACs can vary the credit from sponsors. Sponsors are paid by the success of the SPAC through share ownership, called the promote. The promote allows sponsors to buy 20% of the outstanding shares at a heavily discounted price. For example, Jamataliha SPACs social capital allows sponsors to trade shares for less than a penny per share, while regular shareholders purchase shares at $10. There can be a major disparity in payouts between sponsors and investors. The high number of sponsor shares at a lower price dilutes investor value because the sponsors aren't putting up nearly as much money as the investors, but they are taking a large chunk of the gains. Some SPAC sponsors compare the investment costs due to those of a regular IPO. With that being said, sponsors don't get paid unless the SPAC sponsor well, so they are incentivized to maximize the business acquisition. Investors who are invested in SPACs should spend time to researching the terms of the investment. A good place to start would be to carefully read the SPAC pros- uh, IPO prospectus, as well as the PE reality and current reports filed with the SEC. Investors may also want to evaluate the stock's management team to better understand its expertise, experience, and personal track records. Second, if a target company is identified, investor needs to decide if it's a good investment. One benefit of the traditional IPO route is companies and management team undergo scrutiny from investors, underwriters, and regulators. This scrutiny can helpful in this scrutiny can be helpful in weeding out some prospects. For example, a company will fail to go public because the scrutiny revealed numerous irregularities with the company and its management. Stock shareholders will carefully evaluate the target company when an acquisition is announced. This is when they have to determine if they want to stick with their SPAC or redeem their funds. It's important to note that if you buy a SPAC shares on the open market and choose to redeem them, you will only receive the original IPO value of the shares, which may be different than what you paid on the open market. The SPAC will provide shareholders with an official statement about proposed merger, including historical financial statements and corporate government matters, corporate governance matters. examining. This info is an essential part of determining of if the deal is acceptable. Finally, as with any investment, investors should weigh the opportunity costs. Understanding the track records of SPAC can help. While some SPACs have been very successful, one study from 2010 to 2017 followed, followed 93 SPACs and found that they underperformed a broad market index by 3%. Another study Another study found that between 2015 2000 and 2019, the majority of SPACs were trading below the $10 IPO price. A little more than half the companies had actually made up an acquisition. 15, 15% were in the process of making acquisition, 29% were still researching for a deal, and 4.8% had dissolved the SPAC and returned money to the investors and proportional to their shares. Like more investment, the results are mixed. In the end, SPACs can offer an opportunity to speculate on something new and exciting. However, investment must always weigh the risk and determine how the stock fits into their overall portfolio strategy.